Good afternoon. Thanks for joining us. I'm delighted to see you all here. And it's now my pleasure to introduce today's guest. Rana is an assistant managing editor at Time, writes the Curious Capitalist column, and is also CNN's global economic analyst. Before joining Time and CNN, she spent 13 years at Newsweek as an economic and foreign affairs editor and foreign correspondent covering Europe and the Middle East. But she's also the author of this remarkable new book called Makers and Takers. I got a galley of this book, and I immediately contacted the publicist and said, send me a box full of these things because I want to spread them around to other people. And I proceeded to pass it along to many of the leading lights of Silicon Valley because it's a really, really important book. And the subtitle, I think, really says a lot. It's The Rise of Finance and the Decline of American Business. And it's very provocative, but something that I think all of us need to be thinking about. Anyway, thank you for joining us, Rana. I had a line of questioning prepared, but Brexit has really which is very relevant to this discussion, really has come to the forefront of the news. Brexit, Donald Trump, how are these things related to this topic of the rise of finance and the decline of business and effectively the decline of the middle class?
Yeah, well, I think that they are related. In some ways, both the Leave vote and Donald Trump's popularity are protest votes. It's not so much that the Leave contingency in the UK, in my opinion, has the answers for how to deal with some of the economic challenges that are facing advanced economies like the UK, like the US, many industrial countries in Europe as well. But they are representing an anti-establishment movement in some ways. And one of the things I cover in my book is how the development of financial capitalism in our country over 40 years has been, in some ways, a closed conversation. And there's been rules that have been crafted that, by both parties, Republican and Democrats, that have worked for some people, and I would argue a smaller and smaller group of people, but not for creating kind of inclusive, sustainable economic growth and capitalism across the board. And to me, that's what Brexit is all about. I'm actually personally very sad about Brexit. I was a foreign correspondent in Europe for a number of years. Both my kids were born there, and I covered the beginning of the euro, and it was such an optimistic time. There was a feeling of coming together in economic unity, but there was always this sort of political hole at the center of Europe. Europeans decided to not do the political integration that I think was necessary to make the EU sustainable. And then when bad times came, and you have this slow growth economy, I think that the tide pulls out and you sort of get this feeling of people hunkering down and wanting to be a little bit more tribal. And I think that that's what you're seeing there, and I think that's what you're seeing here in some cases.
So let's unpack this a little bit for people who haven't read your book. So let's talk a little bit about your fundamental notion of how financialization has changed the shape of business. And actually, let's start where you start your book. It opens with a fairly blistering indictment of Apple under Tim Cook.
Yeah.
And and because we think of Apple as this great innovative company, to have them play a starring role in a book about what's gone wrong is perhaps
a little edgy.
A little edgy, yeah. So maybe talk a little bit. What's your beef there?
Yeah, what's your problem with that? It's funny, my editor said that too. You sure you want to start with America's most loved company? And I'm like, yeah, why not? The reason I actually started with Apple, I got interested in Apple because I'd actually done a profile for Time a few years ago on Carl Icahn, the big corporate raider / activist investor. That's a rebranding, which I get into a little bit in the book as well. And he was, until quite recently, holding a fair bit of Apple stock. And he was tweeting every few weeks, telling Tim Cook, telling the board of Apple to do more share buybacks, which many of you probably know when companies do share buybacks, it artificially decreases the number of shares on the market, and it generally has the effect of bolstering the share price, but it doesn't actually really change anything in the underlying corporate story. And it's interesting because not just Apple, but many American companies historically tend to do share buybacks at the very top of the market. So when a stock has risen, when growth has happened, and the company is at a turning point and they don't really have anything else in terms of their growth story to sell to the public or to sell to Wall Street, share buybacks are a good way to keep getting a little bit more stock price hit. The problem is that Apple was issuing debt to do these share buybacks. And that in itself is a little bit ironic because you look at Apple, it's one of the richest, if not the richest companies in the world right now. They've got about $200 billion worth of cash sitting in bank accounts, many of them overseas in tax havens because they don't want to bring back the money to the U.S. and pay the higher than average U.S. corporate tax rate on it. We could go off on a tangent about whether that's really fair, given that so much of what makes the iPhone smart was actually developed by the federal government. But I'll leave that for another question or another panel. But it was a deep irony to me that here's this company that doesn't need any capital, and yet is more involved in the capital markets than ever before. So over the last few years, Apple has made promises to give back to investors in the form of share buyback and dividends, almost as much as it has sitting in bank accounts abroad. And that's because it can do these very low interest bond offerings. It's very cheap right now to do that in the US. Well, why is it so cheap? Because we had a financial crisis in 2008, and because we had no real fiscal policy and politicians were gridlocked and unable to come up with a real way to bolster the Main Street economy, the Fed, the central bank, parachuted in, dumped a lot of money in the economy, kept rates very, very low, so corporations can now take on a lot of debt. So this is a long-winded way to say you've got the richest company in the world holding more debt than ever before, paying out the wealthiest 10% of the population, which owns about 80% of the stock, rather than investing, as I think Steve Jobs might have done, in the new thing, in the big R&D investment, in the blue sky invention that's really going to change the economy. And that, to me, is a very Kafkaesque system and a good place to start exploring this trend of financialization.
Right. Well, there's another aspect to that, which is, of course, that the Apple devices are made in low-wage countries as opposed to being made here, with the argument that you have to do that in order to be competitive. And yet, here's Apple, the most profitable company in the world, saying, well, if we don't use low-wage employers, if we actually did this in America, we wouldn't be competitive. You're starting to dissect sort of the scene of a problem here, which is that corporate profit is made sacrosanct above all else.
Yes.
And that goes back to something that law professor Lynn Stout has called the shareholder value myth. If you scratch, any business person, they'll basically repeat this idea that corporate boards and executives have a fiduciary duty. Their primary duty is to enrich their shareholders. Turns out that there's very little legal support for that, and that boards and company officials have wide discretion to pursue social goals and to do other things, long-term strategy, and yet this doesn't happen. And really, that's a lot of what you talk about in your book. Why? Why?
Yeah.
Can you kind of tell us why is it that people have kind of bought into this?
So Lynn Stout is amazing. She's a professor at Cornell, and she actually did a big interview for the book and has some great stuff to say on this. Chapter 4 of my book looks at, chapter 3 and 4 actually look at this issue. And this myth of shareholder value was part and parcel of what's called the Chicago School of Economic Thinking. It was a sort of a markets know best, just focus on the share price and everything else will sort of follow, social good will follow from that kind of thinking. I'm generalizing a little bit, but that's basically where corporate America was over the last 40 years. And, it's not like there was one change point. We've had a number of decades of small legislative, legal, regulatory changes that have created a system of incentives which now pushes any public corporation in these very, I think, short-term directions towards outsourcing, towards job displacement, towards financial engineering rather than the real kind. And one of the reasons I wanted to write this book is I've been a business and economic journalist for 24 years now, and I would meet these really smart CEOs and many times really good people. They were doing philanthropy and they were involved in their communities, and I recognized them to be really good people, but they'd be making these terrible short-term business decisions that were basically all about maximizing share price, and oftentimes we're devaluing everything else. We're devaluing their own workers. We're not necessarily making decisions that were right for their customer base even, and so we're eroding the long-term potential market share of the company. And it was all down to shareholder value. And then I also had the perspective of having lived and worked abroad and seen some of the models in Europe. I knew that this was not the only way to do things. So I think for until quite recently, this is a very nascent conversation still, people just thought this is how capitalism works. Shareholder capitalism that's what you do. But it's not what they do in Germany. For example, there's a model of stakeholder capitalism that's much more based around local ecosystems in which workers have a seat at the table, civic society and government officials have a seat at the table. There's a shared conversation which, as I explain in my book, can really actually help corporations. One of the examples I get into is after the financial crisis, the U.S. manufacturing sector laid off a huge number of workers. Immediately. And the Germans did this a little differently. A lot of the German manufacturing companies in the Mittelstand near Stuttgart had a different model. They put workers on furloughs, used the extra time to do retraining, upgrading in factories, basically pushing forward their own processes and upgrading them when there wasn't a lot of work to be had, so that by the time the global economy started to recover in 2010 and China was coming back, the Germans were ready to go. They were all up and running, and they grabbed a lot of market share from American companies who had taken this much more short-term, we're just going to cut, we want to cut our capital costs, we want to marshal our capital at the expense of all else, and that turned out to be a very bad decision in the long run.
So let's bring this back around to Brexit. Because, of course, part of what the Brits were saying, at least the 50% of the Brits who voted for, or 50% of those who voted, keep that in mind, that we don't have enough people voting on these important issues.
Gosh, yes, yeah.
But of this large, poll, effectively, 50%, slight majority said we want out from under this European model because we actually don't believe that the benefits of that model have been sufficient. And there's a couple of things there. One is the role of government perhaps over-regulating, but there's also really a real distrust of globalization.
Yes.
And globalization is another piece of this story. And I'm really always of two minds about globalization because there is this very powerful narrative about companies using the cheapest labor they can find anywhere, and if they can't find cheap labor, they're going to outsource to machines. And this narrative of, effectively people are a cost to be disposed of whenever possible. And that's clearly driving this populism. And yet there's another side of globalism, which I see pointedly in Max Roser's tweets, Our World in Data. If you ever seen his wonderful series of visualizations out of Oxford, they're basically changes in world health or world poverty over time. And globalization clearly has brought up large segments of the world. And at the same time, it has actually depressed the incomes of many former people in middle incomes. And so it looks like we have a zero-sum game. Some people are getting worse so that others can get better. And yet, I think the story is more complex than that. And what you've brought to it with this notion of, well, how much is going to corporate profits versus how much is going to workers is another piece of that narrative.
Yeah, absolutely.
And how do we tell the story correctly so that we make the right economic prescriptions for our society?
So it's such a great question, and it's such a complicated topic. The thing that comes to mind is I had a conversation once with Howard Schultz, who is one of the interestingly, founder leaders, it tends to be founders, I think, that think more about this or perhaps have more leeway within the context of their own companies to pursue goals beyond just share price. But we had a conversation about this very topic, and he kind of summed it in an interesting and pithy way. He said, look, we're becoming a nation of latte makers and latte buyers. And I have to make sure that there's more latte buyers because otherwise the math starts to not work. And what he's saying is that in a economy like ours, and which is similar to most advanced economies, where consumer spending makes up 70% of what happens, when people haven't gotten a raise in real terms since the early 1990s, and many working people, aka the Trump voters, particularly laid off white men in the Rust Belt, haven't gotten a raise in real terms since the 70s, you've got a problem, not just economically, but politically, as we're seeing now. So to me, a lot of this is about thinking about the wage share, how to get the wage share up, because over the last 40 years, that's what's so marked is you see, if you divide the economic pie up into the public sector, the corporate sector, and labor, labor's share just keeps shrinking and shrinking and shrinking. The corporate sector keeps getting bigger and bigger because of globalization.
But not just because of globalization, because of choices that companies make, which is partly the short-term profit maximization.
That's true, and yeah, that's right. I'm glad that you rephrased that for me. Globalization is one of the things that enables capital to flow where it wants to, which tends to be where it's cheapest. You're talking about outsourcing to low-wage countries. What I think is that we're at a tipping point with that for a variety of reasons. For starters, a lot of those low-wage countries like China are starting to have their own problems with jobs leaving their country. A lot of Chinese jobs, factory jobs, are now going to lower-wage Asian countries. There's a sort of whole reevaluation of supply chains going on that I think will bring all this into question. But to me, it's what policies are going to increase the wage share in a way that's sustainable and also support local ecosystems. I think that's where the action is.
Yeah, I think this image of latte buyers and latte makers is fairly central, and to the short-term thinking, effectively when you take money and it goes to Carl Icahn, it comes out of the real economy.
Right.
My friend Nick Hanauer, who's a wealthy venture capitalist, was one of the early investors in Amazon, says, I'm a rich guy, but I'm really clear that capital doesn't create jobs. Only customers create jobs. Right. And he said, if we don't pay people enough, they can't be our customers, and we're all going to suffer. He said, I can only sleep in one bed. I can only use one pillow. I can't. I can take. I can take a certain number of vacations more than an ordinary person, but I can't take. A million times as many as an ordinary person. And so there's this circular economy, which is sort of part of the self-interest. Part of what you're really putting your finger on is we've written the rules. And I love, by the way, a book I highly recommend for everyone is Joe Stiglitz's Rewriting the Rules, because he's the Nobel Prize winning economist who's really put his finger on this notion that our economy is not like the law of gravity. There are economic laws perhaps, but there's an awful lot of it that is tilted by the rules that we've written for the economy. And those rules currently favor certain kinds of financial interests over, for example, labor. The tax, the incentive structure for corporate CEOs. So maybe could you talk a little bit about, the trade-offs that we make when we sort of reward financialization over productive investment, when we reward financialization over, hiring people who can also be customers. These are some of the kinds of trade-offs you talk about in your book.
Yeah, for sure. So Stiglitz's book is amazing, and this plan that he's developed, which was supported by the Roosevelt Institute, is a big part of the sort of backbone of my book. I get into some of the suggestions and the pivot points he talks about. One of the things that strikes me, and I have a whole chapter on this, is the way in which our tax code incentivizes behaviors that are not necessarily growing the Main Street economy. So, for example, the tax code subsidizes debt in many ways, in ways that are not necessarily productive at both the consumer level and at the corporate level. So, one example that I think most of us are familiar with is the mortgage interest tax deduction, which I'm a huge beneficiary of. I live in a townhouse in Brooklyn and, get to write a lot of that off my taxes. But what's interesting is when you look at who's benefiting, it's largely the middle and the upper classes from the vast bulk of the mortgage interest tax deduction. And it also has this other perverse effect of pushing up asset prices, because I can tell you housing prices would not be what they are in my neighborhood and probably in San Francisco if people weren't able to write all that debt off their taxes. So then that has the effect of making it harder for younger people to get into the housing market, for example, which is still where the majority of Americans keep the majority of their wealth, and so on and so forth. Same is true at the corporate level. Much, much easier to write off debt from your taxes than it is to say, do something productive with your capital and then be rewarded in some way or incentivized for that investment. So that's one example. I could go on if you liked.
Yeah, it does bring up the whole question of who are the members of the financial class. Certainly, historically, the argument has been, well, this is the pensions of teachers and firefighters, and you look at that, but the pressures that lead to the short-term thinking are not actually driven necessarily by those people. You talk a little bit about Jack Bogle and what's happened with Vanguard and index funds, and they don't have the same pressure that a managed fund has to outperform the market, because they say, no, we are the market. And so if you are an active fund, you're subject to the same kind of pressures of Carl Icahn, where you're trying to actually maximize your short-term profit this quarter so that you'll get more investors, et cetera, et cetera. So the mutual fund industry is actually fighting, in some ways, with the exception of the index funds, really fighting against the interests of its small shareholders.
Yes.
And not to mention that, also charging extensive fees.
Right.
Talk about Jack Bogle a little bit.
So Jack Bogle is awesome. So he was the founder of Vanguard, and he was one of my primary sources on the book. And as Tim and I were talking about earlier, one of the things that was fascinating to me is when I was speaking to folks in the financial industry to do interviews for this book, many of the bankers and the financiers that spoke to me and were interested and agreed with the thesis in the book tended to be older, in their 70s or even 80s, and they had seen the way the industry had changed. So they had seen a time when financiers were stewards of people's money, and banks were basically, and asset managers took people's money, banks took it, held it in the form of deposits, and then lent it out to business. That's kind of what Adam Smith imagined that capitalism should do. I'm going to go astray and then come back to asset managers. The killer stat in my book, by the way, I think is based on some deep academic research that over the last 40 years, that model has entirely changed. So only 15% of the money being held in U.S. institutions now goes to business investment. So the rest of it is existing in this closed loop of trading, of bidding up of existing assets, all of which creates the kind of bubbles that we've seen pop over the last decade and makes it difficult to have a sustainable, non-volatile economy. So let me come back to Jack Bogle. So Bogle started Vanguard funds and, like anybody who's in the asset management industry, saw very quickly that hardly any actively managed funds ever outperform the market. It's just, once in a blue moon does it happen. And yet, because most of us are in 401ks, many of us are in actively managed funds that are pushed by the companies that we work for, who are sold those products by these big asset managers. Asset management, by the way, is the fastest growing part of the financial industry. So we spend a lot of time in this country talking about too big to fail banks, but the action is actually in asset management. That's where a lot of financial business is going. It's where the largest pool of money is. So Bogle, who's a big believer in, you put your money in an index fund and you forget about it until you're 65 or 70 or whenever you need it, started crunching some numbers on all this and found that for the average person who has their retirement egg in an actively managed set of funds, pays those higher than average fees, and then deals with the lower than average returns, that will eat up between 30 to 60% of your nest egg over your lifetime. So it is really a scandal I think, and it's something that policymakers are starting to talk about. We're starting to see push, as is here in California, for state-run plans where folks that don't have access to investment vehicles can be put into no-load index funds, and so on and so forth. There's also an argument to be made that, Social Security should be strengthened. It's working. The private retirement system via actively managed funds is not working so well for most people. And I'll just make one more statement, which is that what's interesting is, as with so many aspects of the rise of finance, it's as though the head of the snake is beginning to eat the tail. Asset managers themselves and pension fund managers are starting to become panicked because they know we're entering a period of lower than average returns. In my mind, that's because we've had a very financialized kind of growth, a faux growth over the last 40 years as opposed to real growth. And so returns are going to be lower than were expected and were promised to many retirees. Retirees were made promises of 8% returns. They're going to be lucky to get 4%. And there's going to be a real political backlash against all that.
Yeah, it's very interesting because there was a real opportunity with low rates. I still remember hearing a Larry Summers rant, right, when he was talking about the crumbling state of our infrastructure
Yeah.
and saying, if there was ever a time to invest in public infrastructure, this is right after 2008. He said, we have all these people out of work, we have zero interest rates effectively. Why would you not do all this work now? And instead, we took those low interest rates and used them simply to reinflate the bubble of the trading economy, which, as you point out, has supplanted real investment. The original role of the financial sector was to support the real economy.
Yeah.
And instead, it's become this bubble economy where basically there's a giant casino where there's more money to be made simply, betting or skimming the spread.
Yes.
In the financial markets rather than reinvesting in a real business.
Yeah, for sure.
So what do we do about this? I mean, what are some of the concrete recommendations that you would make?
Yeah, bleak enough for you yet? We're gonna move into the solutions portion now. So I have a solutions chapter in my book, but there's a broad array of conversations going on. I mean, you're leading some of them. I would start, and I do start in my book with, I think that the first thing we need to do is change the narrative. There is still a narrative in East Coast policy-making circles, in Washington, in the Treasury Department, certainly on Wall Street, that the financial markets are the center of everything, that they really are the most important aspect of the economy, and it's the sort of got to save the banks to save the real economy sort of argument. Well, I would flip it and say the financial markets, financial services, and I stress the word services, are meant to serve other industries. And one of the things I do in my book is to try and lay out all the tension points that exist now between finance and real businesses, because what's happened is that not only has the financial sector changed its business model in such a way that it's no longer supporting actual industry, in many cases it's competing with industry. So if I can speak for just a moment, one of the chapters in my book, I believe it's chapter 6, is on commodities prices and how volatile they've become because banks have gotten into the business of owning actual physical commodities. So for example, that used to be illegal for Goldman Sachs to own half of the world's aluminum, as they recently did. You guys might have read the wonderful front page New York Times story from about 3 years ago. Goldman had cornered the world's aluminum market, and there are rules that are out there to prevent people from hoarding materials that we need for basic businesses to create products and machines, and in the case of wheat or rice or grain, to actually feed ourselves. There are rules that say you have to move those products in and out of warehouses every so often, and that's supposed to help us get around hoarding. Well, Goldman was moving the aluminum. It was just putting it on a forklift and moving it from one side of this room to the other and getting around the rules that way. And so they were cornering the market, and this had an impact on the real economy. For starters, it drove up the price of aluminum wildly, which hurts Coke, it hurts Coors, it hurts anybody that has to make aluminum cans. It also means that you were paying more in those 2 years for your six-pack and your drinks. That's a fairly mild example of how this can play out. I had a conversation for my book with a woman named Josette Chiron, who used to run the World Food Program. And she used to go around to places like Davos, where the big muckety-mucks hang out and talk about this stuff. And she had a little red cup that she would take with her. And that cup held a day's worth of grain that would be delivered via the World Food Program to hungry children. And she would stand in front of people and she would say, this was right around 2009, 2010, when commodities prices had spiked. And she would say, this is how much grain I can give each child around the world every day. And then she would pour out half of it. That's how much I can give them now, because the cost of wheat and rice and all other kinds of foodstuffs has gone up so much. And it's gone up because traders, which now represent 30% of the commodities markets, are driving those food prices up. So that's just a very visceral example of how you have a financial system that isn't just it's not just not lending, it's actively not supporting and degrading real business and society. And so we've got to change those things.
Yeah, so that's really, I think that story is in a nutshell. We have a financial market that in many ways has become hostile to the real economy, and that we need to reverse that. And I think it starts, I think you outline, it certainly requires perhaps some new financial regulation, but it also starts with a sort of a change in some of the incentives for corporate executives. It requires changes in the tax code. Are we going to get there?
I think we're starting to get there. I'll continue with this commodities example because it's an interesting one. That's real low-hanging fruit. The Fed actually has the ability to change the rules that would allow banks to do those kinds of activities. They could simply say, you know what, Goldman Sachs, you have no reason to be in the aluminum market. Forget it. You just can't own aluminum anymore. And they haven't done that. Well, why haven't they done that? I think under Janet Yellen, you might start to see the Fed become a little bit more active in its regulatory oversight role of banks. And it doesn't mean coming up with complicated new rules. It just means, in some cases, looking at all the activities that financial institutions are doing and saying, okay, that has social value, that doesn't. That has social value, that doesn't. And I think we're going to see more of that. I think that the tax code is very low fruit as well. I mean, it's politically contentious because there's so much lobbying from different special interest groups, and that gets to the idea of money politics, which is behind so much of this. Yeah. One of the reasons that that I wrote this book, actually, and this is the author's note that I put in the very front of the book, is I was just stunned post-2008 by how much power the financial industry and how much money they were throwing at slicing up all the new rules, the Dodd-Frank rules that were supposed to kind of re-regulate the system. And it was so perverse because not only did it make it difficult to implement some of the good rules, but it also created a lot of complexity that just made the regulation itself start to be onerous and something that neither side of the political aisle was happy about. So I had a conversation, I was in 2013, I was sitting in an off-the-record conversation with a former Obama administration official that had been very involved in the bailouts. And we were having this conversation over money in Washington and the lobbying power of the big banks. And I said, well, do you think that this has really made it difficult to get Dodd-Frank to work properly? Does it work at all? Is it going to help? And he said, oh, yeah, we got done what we needed to get done. And I said, but, I just did a column looking at some public records that showed that 93% of all the meetings about some of the most important parts of that regulation were done with the largest banks themselves. So how can you say that, it's unbiased? And he looked at me with real confusion and said, well, who else should we have been talking to? And wow. I just thought, oh, my God. I looked around and I was, this is the other thing. I was one of the few non-financial beat reporters in the room, which was telling because the media's been part of this. One of the reasons that this story didn't get reported well is that financial reporters have to go back to this well again and again and again to talk to the Treasury officials, to talk to the bankers. If they piss somebody off, they may not get their story the next day. So, it's all this very vicious cycle.
Yeah, so obviously we're in a different political environment today. Do you think that, first of all, there's, Bernie, Elizabeth Warren, and then on the other side, Donald Trump here in this country, speaking with varying degrees of insight and intelligence, wildly
that's
varying.
charitable.
Yeah. But do you think this actually, you say, well, actually, and then on the European side, Brexit actually came out in the opposite way that the elites expected.
Yeah.
Does this change policy? Does it make people more receptive, or do they just say, we dodged a bullet, or...
Yeah, well, it's really interesting. I mean, the reaction just over the last 3 days in England has been fascinating, where you see even some of the people like Boris Johnson, for example, a conservative in the UK, who was very pro-leave, suddenly sort of being like, whoa, okay, maybe this isn't such a good idea, stepping back, thinking a little bit about what this would mean economically. I think it's very possible that you might have a cooling out period, a new election, and if there were then a clear mandate, a democratic mandate, a pro-EU leader and a pro-EU government came in, that you might then have another vote that could go the other way. And I think that could be politically acceptable.
Right. The question that I'm trying to get to, though, is, Brexit was a very crude tool to get across a message that's, for a class of people saying the economy may be working for you guys, and it may be working for big companies, but it's not working for ordinary people.
Yeah.
And, the appeal of Bernie most certainly has been around that issue. And, Trump, with a lot of other things mixed in, has also, played on that message. And, seems to me that we have one path where we feed that in all the worst ways, which, we have been seeing. And there's another path in which, policymakers say, actually, there really is starting to be a real problem here that's being highlighted.
Yeah.
We have to start thinking about how we're going to deal with it.
Yeah.
Do you see any signs of that? Or is it just like, well, we just got to contain this and kind of get things back where they were and it'll all be okay?
I feel like I'm starting to see nascent signs, and I'll tell you a couple things. I was very worried early on in the campaign about how Hillary Clinton seemed to be saying, we just need to get back to the 90s. I'm going to put Bill in charge. Everything's going to be fine. That to me was the the kind of attitude that can sometimes provoke anger in the parts of the population that have suffered from globalization and have suffered from financialization. And then you begin to get a population that feels not understood, not listened to, ignored. In recent weeks, I think it's been interesting. Her last couple of economic speeches, she did not say the 90s were great. She did not say, I'm going to put Bill in charge. She did start to actually break with even some of the Obama policies, which I think is not a bad thing for her to do, because I think she needs to, if she wants to have a chance as an establishment politician, and we know how establishment politicians everywhere are under a lot of pressure and that there's a trust gap. I think she needs to really stake out a clear message and say, as you just did, globalization has increased prosperity at a global level. It has increased prosperity in many ways at a national level, but there have been winners and losers in this process. And we need to make sure that we retrain and compensate and come up with ways to take care of the people who have not fared as well in this process. I think getting Elizabeth Warren on board, too, is a very interesting thing to do. I mean, you need people to be able to speak clearly and authentically to those that have felt hurt by this process. So I think that those are a couple nascent, potentially positive signs.
Yeah. How about Europe? Any movement there?
Well, Europe is going to depend on whether the continent takes, how the continent takes this message. To me, so I covered Europe for 10 years. This idea that you could have a currency union without a real political union, I think, was always fragile, because it works in good times, but the minute there's a downturn and countries need to be able to devalue or need to be able to have different fiscal and currency policies to be competitive in their own ways, the whole thing starts to fall apart. And that's exactly what you've seen in the last few years with the European debt crisis. The Germans have done great, but the Germans have done great because they're sort of like the China of Europe. They prosper at the expense of other nations. And then eventually, as the peripheral nations become weaker and weaker and can't buy their stuff, they also start to have a problem with their economy. So I think ultimately Europe will need to have a true fiscal political union, a kind of a United States of Europe, really, to make it viable and to make the debt crisis go away. How many countries will want to be in that then becomes the question, because I think that you can make the argument that the European project became too ambitious in terms of the number of countries that were brought in and just the huge cultural differences. I mean, even just getting the Germans and the French on board with something is no easy task, let alone the Greeks and the Portuguese and the Eastern Europeans.
So let me turn this a little bit towards technology and its role in all of this. Obviously, this is something I think a lot about. It's the focus of my Next Economy Summit that I'm working on. There's a lot of concern that technology is going to take over where financialization left off, and that Silicon Valley is going to be the next Wall Street, effectively, where, the target of populist hatred. We've already seen it, the blowback against, companies that really think of themselves as, wow, we're the good guys. We're really trying to do good in the world, and yet, you look at the attacks about gentrification in San Francisco, real estate prices, and then even things like the risk of, for example, the latest being self-driving cars. Once we have self-driving trucks, everybody's saying, "Oh my gosh, that's going to put millions more people out of work."
Yeah.
How do we think about as a society about our policy response to these things?
Yeah.
It's pretty clear that self-driving cars are a good thing. They will reduce traffic deaths. They potentially could open up enormous new industries. I keep thinking every time I have this conversation with the folks over at Uber, I say, you totally missed the trick when you talk about self-driving cars, because all you talk about is getting rid of jobs, and it'll improve your costs and so on. But you had this great demo like a couple of years ago where you delivered flu shots. Once you have self-driving cars, what will those cars be delivering? They could deliver all kinds of new services. We could think about restructuring new kinds of industries.
Yeah.
Deliver better service to more people, because that seems to me to be the heart of the challenge we face. This real economy challenge that you talk about, the real economy versus the financial economy. And in the real economy, when we put people out of work, with machines in the Industrial Revolution, we say we took them off the farm, we created this enormous new consumer goods market that didn't exist before. People used to own, one or two suits of clothes, and now we own, at least in the developed world, many. It becomes a fashion and creative economy built on top of the industrial economy. But we also did things that were impossible. I mean, if you spoke to those people in the Industrial Revolution and said, we're going to use these machines that we put out of work and we're going to dig a tunnel over to France. They would have been just, oh my gosh. And I think, what are the things that we should be working on as a society? If we were to invest in the real economy, what would do you have any prognostications about what we should be investing in?
Well, so, this is such a rich topic of which you know much more than I do, but I'll just make a few comments. Definitely, until pretty recently, I had been very worried as well about whether or not Silicon Valley was just going to pick right up from Wall Street, as you say, because in part, the biggest firms, the Apples, the Googles, are now able to act in some ways like banks. In addition to just borrowing huge sums of money, they also underwrite corporate bonds now. They have so much cash on the balance sheets that is not being invested that they can go and buy up 50% of whatever new corporate bond offering is happening. So there is literally financialization occurring amongst some of the top firms. And we know also that if you look at market share, this generation of tech firms creates fewer jobs comparatively to market share than even the older generation, Microsoft, IBM, and certainly much fewer than like GMs, GEs, the big industrials of the past. So there is that downward trend. But I've become kind of really interested recently. It was in part because I read this book by a British author named Paul Mason called Post-Capitalism.
Yeah.
And it was a little bit about financialization. but it also had a kind of a relatively optimistic view about the possibility of digital technology to empower labor in this almost kind of post-Marxist way by making it possible for labor to have some of the benefits of capital. So, and this is, you and I talked about this recently. I just did a piece on platform cooperatives that are springing up. Cooperatives have been big as a business model in the agricultural sector for some time. It's when, say, groups of farmers come together, like Ocean Spray, the big cranberry company, is actually, it's not a typical company, it's a cooperative, a collective of 750 farmers who simply have a kind of a company that lays on top of their organizations that manufactures and brands and sells their products. And so they are able to get a much greater wealth share than they would have working on their own, and they are able to charge about $45 a bushel for their cranberries versus the going price of $15 because of those economies of scale. So that could work, I think, in many ways in a digital economy. You already see in many cities in Austin and New York, disgruntled Uber drivers going out and starting their own platforms. You see healthcare cooperatives springing up. So I think this idea of going back to the labor share, helping get technology helping to empower labor in a way that labor can take more of a chunk of wealth could really be quite profound. We have to get the rules right, though. We need things like portable benefits. We need the government to create a framework that will make this happen in a way that is doable.
Yeah. So we're running to the point of time where we would like to have questions from the audience. We've been collecting questions on cards, but we also have opened up for the microphone.
I've been interested in this subject that Time did in 2007 on national service for 35 years. My question is about values and media coverage priorities. Time did this in an election year. I would like to see Time do a similar article this year, but focus on the Congress.
And you mentioned briefly about coverage priorities. We are actually trying going forward to do national agenda type coverage issues. I did my book was actually excerpted in a piece questioning the future of capitalism, and we're trying to put together a series of big cover stories that would look at the agenda that the next president and the next government should take on. So we are on that, and I thank you for the suggestion.
Yeah, I will attest to the fact there's certainly a lot of work going on in various think tanks and so on as well. People working this. I was part of a Markle Commission thing on the future of the economy. We produced a book called America's Moment. And there's a lot of work going on with the Aspen Institute, Roosevelt Institute, as you mentioned, New America.
Yes.
So it's clearly a big part of the discussion. But specifically to your point about national service, I think it's a really good question. And I actually had a somewhat different perspective on that yesterday. I spoke with a man who was a former financial trader, actually, but he was also clearly ex-military. And he was talking about the competitive spirit among financial traders, which was sort of a way I hadn't thought about it. He was like, this is like the big league sport.
Yes,
it's like he
totally.
said every day you go to work and there's somebody else out there who is trying to take all your money. and the kind of people it attracts are very, very competitive. And I just sort of had this flash. I look at this guy, I go, you're clearly ex-military. Is there any connection? He says, oh, yeah, And it led me down a path of there's a class, of activities that we don't really have a channel for in our society. And you think about the competitiveness of sport, the competitiveness of many games, the competitiveness of business. And then I said, gee, I wonder actually if there's a connection, for example, in Israel where they have compulsory military service, and there's a very entrepreneurial culture where they've actually found the way to take young people, take that, that energy, and then marry it with discipline so that then, so again, I think, there could be some real benefits to a national service program that was universal and maybe even compulsory, you're shaking your head. You don't like compulsory, but...
No, but it's an interesting, because I take your point. These talents, and I actually get into this in the book, the brain drain to Wall Street, because that's where the compensation has been really profound. I got interested in this because I had a friend who was a French mathematician who had thought about going into industry to develop green engines and ended up doing, kind of 12-dimensional algorithmic models for a high-frequency trading house. And so it's, somehow if we could funnel this talent and this drive into more productive areas, it
Well,
could be really,
I can
good.
also give you a counter story. I have a friend who was a Wall Street quant who actually left that job to take a job at an energy startup. This is actually a company that was started by my son-in-law that was later acquired by Google, Makani Power. They do high-altitude wind energy. And his reason why he wanted to do it, he said, the math is harder.
Oh, wow.
And, so there is this...
That's a good slogan. Our math is harder.
Yeah, I do think, for example, there's a big driver in Silicon Valley. People want to go do things that are hard. And when I think about the next economy and the kind of leadership that's missing, from our political discourse, it should be a lot more about things that are hard and necessary. And we have inspirational moments. We see retired business leaders like Bill Gates saying, "Yeah, we're going to go tackle malaria. That's hard."
Yeah.
And or Elon Musk saying, "We're going to go to Mars." Or with his Hyperloop stuff, we're going to actually totally rethink transportation. And that's one of the really appealing things about Silicon Valley, is some of the big think. And we need more big think across the board, I think, of how do we take all of this reservoir of talent, and how do we stop thinking of people as a cost?
True enough.
And start thinking of them as an asset that we could deploy to do something useful that needs doing, that must be done. And that, to me, is a big part of this. So we stop, putting so much money into the casino and start taking it back towards productive investment, because it's going to require actually productive investments that excite people.
Yes.
When they were saying, we're going to put a canal through, the Isthmus of Panama. That was like a huge investment thing, because it was hard, it was big, it was going to make the world richer.
Yeah.
And I do think that that's a big part of what we need, is the vision of how else we could spend that money besides just playing in the financial services casino.
I totally agree. It's funny because I did, and I'll just say one thing before we're taking their question. I did an interview with Mark Bertolini, who's the head of Aetna, and he had a statement to make to me on this score. He was saying that, business schools, he can't find who he needs from business schools these days, because they always teach leaders to marshal their capital and ignore human talent, that that's a cost rather than asset. But he thinks that it needs to be shifted over into the asset part of the ledger, and that you spend more on that, and it is an asset that grows, and I think a lot of business leaders feel that way.
Yeah, I have two more questions here that I want to take from the cards about Brexit before we get to you. One says, to what extent have austerity and supply side theory contributed to Brexit and post-recession stagnation? Acknowledging there are other factors at play as well. So austerity, key point there. And then the second question, which is also about Brexit, says millennials were not supportive in general of Brexit. So how do you see millennials shaping the future of the EU? And I'll extend that out further to just this whole question of shaping the future economy.
Okay, so quickly on austerity, I think that it was a mistake. We can all see that now, widely agreed to be a mistake. I mean, the European crisis was a debt crisis, and countries needed to get their balance sheets in order. But austerity in the middle of a recession is that's kind of Keynesian economics 101. You don't do that. The problem was, and I was in Germany during the debt crisis, and so I was reading the papers there and really hearing that debate. There is a strong sense in Germany, which is the Germans really had to get on board with a fiscal stimulus program, otherwise it wasn't going to happen. There was a strong feeling in Germany that they had the way, that they had done the hard lifting, they'd got their balance sheets in order, and why shouldn't everybody else do the same? Italy and Greece should just get their act together and be more German. The problem is everybody can't be German, because then there's no one to buy stuff, So but that honestly, it's almost a moral issue amongst Germans. And to be fair, it's interesting because it dovetails with this idea of stakeholder versus shareholder capitalism. They do have some amazing corporations there that are just models of how you want to run a corporation. The problem is that at a macro level, Not everybody can be an exporter. So again, this goes back to, I think that they're going to have real political integration to have wealth transfers the same way we do, the same way California supports Mississippi sometimes, in order to really resolve the debt crisis. In terms of millennials, yeah, I think that is the big question, and I just don't know how the UK can stay forever out of Europe when the entire young population sees its future within Europe. One of the issues that's going to be interesting, though, is, in France, or excuse me, in Spain, Greece, Italy, you've got double-digit youth unemployment. You've got a group of very angry, disenfranchised young people. That's a tinderbox, and I don't know how that's going to play out.
Well, the one question I have is, when does self-interest take over and companies start realizing they have to invest in their local economies as opposed to just optimizing for one thing? So, over to you.
Do you think it's possible to restructure our economy in such a way to handle a lot of the problems that you've been talking about with labor force and basically inequality, as well as handle some of the environmental challenges that capitalism has posed so far?
I do. I mean, something that comes to mind is platform cooperatives that would link up smart energy grids. You could sort of imagine, I'm sure that there must be people in California already doing this that I'm not aware of, but you could imagine everybody, paying into a sort of an energy grid and then having sharing of resources, that being run by cooperative companies where labor would own a larger chunk of the firm. I think that there's tremendous possibility here. A green moonshot program, by the way, is, I think, the fastest way to deal with any number of things: climate change, job creation. Joe Stiglitz, again, has written a lot about this, as have many others. I think one of the issues there, the challenges, is it has to be a global effort. But, I mean, China is increasingly on board with this. I think that their elites recognize that environmental degradation is probably the biggest medium to long-term economic threat they have. So I'm kind of optimistic about the possibility of collaboration with China on that.
Yeah, I've had that same thought, that actually it may be climate change that rescues us from the what I sometimes call
stagnation.
the WTF economy.
Yeah.
Because we're going to have to deal with it at some point, and it will actually soak up a lot of labor and capital that's been going to non-productive uses.
Yeah, exactly.
Yeah, thank you. It looks like we have someone else coming up here.
Given that Brexit was a crude instrument to put a point across, isn't Donald Trump similarly a crude way of getting our point across, and how can we avoid that?
Oh boy, yes, in a word, yes. I think that Donald Trump, and to a lesser extent Bernie Sanders, just exemplify this frustration with political elites. Unfortunately, in the case of Trump, I'll just say dispassionately, as somebody that looks at economic arguments, I don't see anything in his economic plans that would address any of the problems we've just been talking about. In fact, it's kind of trickle down on steroids, really. It's about tax cuts, no spending cuts, sort of a dash or two of populism around cutting loopholes for hedge funders to sort of, please his voter base. But there's nothing there that really addresses these challenges. I think, Hillary, as the establishment candidate, I'm hoping will continue to put forward, as she did a couple weeks ago in her second economic speech, a vision that really connects some of these dots, talks about the labor share, talks about the importance of, stakeholder versus shareholder capitalism. She made an announcement, I believe today, I haven't looked closely at it, about making college debt-free for entrepreneurs, for people that go out and create businesses. That's another interesting way of connecting the dots between education, the cost of education, and entrepreneurial zeal in the economy. And I think, more of that is what I'm hoping for, so that people will be able to get excited about a future agenda.
Yeah, I do think there's a really interesting part of this entrepreneurial narrative, which is so dominated by Silicon Valley and big scalable companies, when in fact what we really need more of are small businesses that are part of a community and that people want to own for a long time. Because there is a financialization narrative in Silicon Valley as well, where the objective is really to exit, which turns it into a financial play. as opposed to, the great companies, of course, do become operating companies that, continue to deliver value and service in the real economy. But a huge amount of the enthusiasm in Silicon Valley is, again, it's another flavor of the financialization game.
I totally agree, yeah.
Do we have another questioner here?
You brought up the issue of the money that's overseas with all these corporations, and we've read about all the proposals. And would you have a recommendation about how it should be handled by the United States?
Yeah, so a lot of people are calling for kind of a one-time exemption to bring back some cash. We actually tried that in 2004, 2005. Cash did come back, but the majority of it did not go into capital investment. It went into share buybacks. I've talked to various tax experts who say it would be very, very hard to craft rules for an exemption where you could track, yes, this is being put into retraining workers, or this is being put into new R&D spending. It's just very difficult and cumbersome to do that. I personally am for a somewhat lower corporate tax rate, but all loopholes closed, make it a little more competitive internationally, shut down the loopholes, shut down the perverse incentives for debt, but I don't think a one-time exemption to bring back overseas cash is a good idea.
So can you just spell out what's not competitive about our current tax code?
Well, it's about a 35% rate right now, which is far higher than the OECD average. The problem is there's so many loopholes, and it's so huge and complex that the majority of S&P companies pay about 20%. There are many, particularly in technology and in financial services, which are basically IP-driven businesses, and you can relocate IP wherever, that pay 12, 13% tax rates. So it's not as if anybody's actually paying the 35%. But I think a much healthier way to deal with this would be not to create jobs for tons of tax lawyers to jump through the loopholes, but lower the rate a little bit, close the loopholes, and let's try and get everyone paying what is a fair and globally appropriate standard for a rich country.
Yeah, I think that's a really good point. I know, certainly there was a lot of discussion of how tax avoidance has played a role, for example, in the Greek economy.
Yeah.
And it is one of those factors that, we kind of look the other way and don't address. And I think you're absolutely right that a fairer tax policy that is also perceived as fairer will have a big influence on all of these issues. Well, thank you very, very much, Rana.
Thanks,
and I hope
Tim.
everyone else enjoyed this as much as I have.
Thanks for having me. Thanks, WAC.